there, this is Brian from quantlabs.net. This is probably one of the most important videos I have ever done. This is going to address as a milestone on the trading foundation and psychology blueprint. And the goals of this presentation are 4 elements. Staying profitable in the long-term trading game. I'm going to try to address the myths why 99% of all retail traders will lose with blown out accounts. Now, of course, we need to set parameters to impose non-risky trading limits and how we address non-techies through an alert service. So there's 4 steps. First, I'm going to talk about the worldview that we generate, and that's over a time of horizon of 1 to 3 months. And we're also going to talk about trading idea generation, then screening, and then risk management. Now, there's some caveats of this presentation. First, it's very generic, and it's done that on purpose. So there's no drill down. So there's really a 35,000-foot view. Now, in terms of specific solutions that will be addressed at this end of this presentation, and this can be automated, but will be addressed again towards the end. So first, let's talk about our current worldview. First, we need to generate trading ideas from the top 3 world regions, including the USA, Eurozone, China, which can represent over 50% of the world GDP. And from that, we get trading ideas that can be generated from these. And of course, all these reports include qualitative analysis for each sector, but hard to automate. So let's first talk about the US. The US is the largest at around 18 trillion of GDP. There are 3 major reports that you can use from the ISM, the PMI for manufacturing, from the Institute of Supply Management, which includes durable goods, ESR, etc. We also use the Consumer Index Survey for consumer sentiment and confidence. That comes from the Michigan State, and that will include jobless claims. And there is another indicator we could use for home building stats. Now, the other region that we need to focus on is the euro, which is obviously the second largest at around 15 trillion GDP. So, from there is a Euro Community Manufacturing Report, and from that we generate and focus on the strongest markets by country versus the weakest markets. So what we do is we sort the company via sectors for the strongest, which is our long, versus the weakest, which is our short. Now this is important. You do not use any middle country or company, as these are considered dead money, which will weaken your max profitability opportunity. Now the other region we focus on is China. So most know that you do not use the government PMI reports, which are pretty well unreliable. The only one you can really use is the HSB PMI report, which includes smaller non-state companies for max profitability opportunity. Now, China will be the largest trading region within 10 years. Okay, so we got our current worldview. Now, from there, as I said, we're able to generate trading ideas. So we need to understand basic stats principles, retrieve industry by sector, and even stock views with the following slides for econometric indicators. Now, for retail traders, with the current market activity, we use that as pro traders. We use that as liquidity, as those retail traders catch up to market conditions 30 to 90 days out. Now, as part of the statistics for asset return calculations, what we're using is market data which is sourced from free Yahoo Finance. We are able to use normalized distribution with understanding of basic stats with daily or any other period return of assets. We calculate those periodic asset returns. We also use descriptive statistics like as in mean, standard deviation, kurtosis, and skewness, and so on. From there, you should be able to use these methods for stocks, currency, indices, bond rates, commodities, and so on. Now, out of that, what we try to do is prioritize our market sector and assets. So when selecting the assets to filter strongest versus the weaker player. Now remember, that's the long versus the short. We're only using the market cap of at least 1 billion with a positive beta. We do that for liquidity purposes. Now, what we're trying to assess here is the positive direction of the market with a potential bull or bear market condition, but can be identified by region as well. Now, also using Black-Scholes, we try to calculate the implied volatility with American or European call option data on the underlying asset with no dividends. We then forecast over a monthly, quarterly, or a yearly set of volatility, and we also use a short-term treasury yield return as a proxy for risk-free rate. We do not use VIX as that's current, and we want to predict direction over a 30 to 90-day time horizon. We also use average true range, also known as ATR of the asset to predict direction. All trading forecasting frequencies could be used from weekly data. Now, what we're really doing is pair trading via spread calculation. So again, we're using Yahoo Finance data with the open, high, low, close, or OHLC for the pair. We calculate the spread on the pair. We also calculate the market and sector risk, and we hedge that out. We chart the spread over a weekly or monthly view for market direction. From there, we create an active watch list to adjust our weekly view. So what we're essentially doing is adding a list of trading ideas with potential performance measurement for trading opportunity. We divide those into asset types, including currencies, stocks, etc. We also measure long versus the short spread calculation with current price and market entry prices. We also include a spread with a percentage and total weeks on the list. The spread should be forecasted for up to 8 weeks. Now, what we're trying to also do is screen. So for each pair on the watch list, we calculate the daily ATR with prediction for multi-years. We also use a spread on a chart with a trend line with a moving average of 20-day trading day period, which is really 30 days. And we also use a 60-day trading period for moving entry versus exit on the cross. We also use other technical analysis indicators for confirmation on timing of the trading opportunity. We also use pricing action as in, for instance, technical analysis support resistance and shoulder, etc. to constantly adjust our rolling stop loss applied on all open trades. Now, as part of that, we also have to include critical risk management. We use rolling traded asset beta to measure our portfolio market asset weight allocation within open positions. That's again, long versus the short. We measure our exposure rate with potential margin call based on past performance, as in multi-year for trading performance as it improves. We also use Kelly criterion for self-imposed weight allocation on each position size based on trading performance. We can also rely on stop loss to automatically trade us out for potential profit. And important, we need to distinguish between our rolling hard and stop loss trading targets. Also, which is really important, and it's a misconception for retail traders. Now, with the day trading versus the task of being a portfolio manager. Now, here's the important thing. Over 80% of your trading types or tasks is spent as a portfolio manager versus a short-term day trader. Day trading alone has proven to be unprofitable over the long run and high risk for lost profit. Also, technical analysis cannot be used alone as a measurement of market condition for profitable trading ideas as it is measured currently. So, what are our lessons for automated trading? Well, we're going to obviously use a database to track things like Kelly criterion and all other measurements explained in this presentation. And the technologies we're using are Java, Excel, MATLAB, which are best for automated trading of this blueprint. Now, this is the thing, really important. The proposed automated trading system will not be released for any type of consumption at all. Why? It's too valuable. Now, for my quantlabs.net members, they'll receive through an alert service a daily watch list, trading exit entries, forecast reports with econometric indicator calculations as described above. Now, more quant trading models could be applied to the system, but where does this fit in the future? Now, of course, this blueprint may prove that evolutionary or machine learning may be dangerous, as your model will not be able to adapt to fast market-changing conditions, as in geopolitical events that can negatively impact your portfolio. I'm hoping you got some important lessons from this, and as I keep saying, join us to learn how we implement this. Thank you very much for watching.